There is a question that millions of people around the world carry silently inside them every single day. It sits quietly at the back of the mind during morning commutes, during long office hours, during every moment when the gap between where life is and where life could be feels especially wide. The question is this: is it truly possible to make a living from the financial markets? Is it possible to sit down each morning with a chart, apply a set of skills, and by the end of the day, have generated real income through nothing but knowledge, discipline, and the ability to read what the market is telling you? The honest answer is yes. But the honest answer also comes with a warning so important that most people who get the yes never stop to absorb the warning. Yes, it is possible. And the vast majority of people who try will fail, not because the goal is impossible, but because they will approach it the wrong way. They will trade on emotion rather than analysis. They will risk too much. They will never develop the psychological discipline that separates the professional from the crowd. They will quit before they have truly learned. This is why Trading for a Living, written by Dr. Alexander Elder, is one of the most important books ever written about the financial markets. It does not just teach you how to read a chart. It teaches you why you behave the way you do when real money is on the line. It teaches you how to build a trading system, how to manage your capital, and how to develop the inner discipline without which every trading tool becomes useless. Elder was not just a trader, he was a psychiatrist. And that combination, the science of the mind meeting the science of the market, is what gives this book its unique and lasting power. By the time this journey through the book is complete, you will understand the three pillars that every successful trader must build. You will understand why most traders are really gamblers in disguise and how to escape that trap. You will learn to read the hidden language of price, volume, and trend. You will understand the triple screen trading system and how it uses multiple time frames to produce powerful trading signals. And you will learn the money management rules that protect your capital even when the market goes against you. This is not a book about becoming rich overnight. This is a book about becoming a professional. And that journey begins right now. Chapter 1: The Individual Trader and the World of Markets. There is a moment that nearly every person who enters the trading world remembers with vivid clarity. It is the moment of the very first trade. The chart moved in the right direction. Money appeared. The world felt charged with possibility. For a brief moment, a gateway had opened between skill and freedom and wealth, and the feeling was intoxicating. And then came the losses. For most traders, the losses arrive gradually at first. A bad trade here, an unfortunate timing there. The explanations are always ready. Bad luck. A news event nobody could have predicted. A temporary glitch in an otherwise reliable strategy. The losses are absorbed, more capital is added, and the trading continues. But over time, if the trader is honest, a pattern becomes visible. The losses are not random. They follow the same emotional logic, the same psychological cycles, the same invisible script that replays itself again and again, regardless of how many new indicators are downloaded or how many new books are purchased. Elder opens this book with a truth that most trading education carefully avoids. The financial markets are the most competitive arena on earth. Every single trade you place is taken from or given to some of the best resourced and most experienced participants in the world. Banks, institutions, hedge funds, and professional traders sit on the other side of your transactions. They have faster technology, larger research budgets, and decades of disciplined experience. And yet, individual traders enter this arena every day, many of them believing that enthusiasm and a basic chart reading course are sufficient preparation. They are not. But this is not a reason to give up. It is a reason to get serious. Because Elder also makes clear that the individual trader has a set of genuine advantages that the large institutions do not. An institution moving hundreds of millions cannot enter or exit quickly without moving the price against itself. It cannot shift its strategy overnight or trade tiny opportunities that are too small to matter at its scale. The individual trader is a speedboat navigating waters where ocean liners struggle. Speed, flexibility, and the ability to act without committee approval are extraordinary advantages, but only if the trader has the knowledge and discipline to use them. The core argument of the first chapter is simple and profound. Most individual traders waste these advantages entirely, not because they are stupid or uninformed, but because their psychological relationship with trading is fundamentally broken. They trade too much. They hold losers too long. They exit winners too early. They increase position sizes after winning streaks and make desperate trades after losing ones. These are not market problems. These are problems of the human mind operating under pressure, and they are present in almost every trader who has not made the deliberate effort to understand and overcome them. The market, Elder is careful to explain, is not your enemy. The market does not know you exist. The market is the collective expression of every decision made by every participant at every moment. It reflects fear, hope, greed, panic, optimism, and despair, all compressed into the movement of a single line on a chart. To trade successfully, you must learn to read that collective human behavior, to see it for what it is, rather than for what you hope it to be, and to make decisions based on what you see rather than what you feel. This is harder than any technical skill. It requires a quality of honest self-observation that most people never develop in any area of their life, let alone under the financial pressure of a live trade. But it can be developed, and developing it begins with understanding the psychological forces that are working against you every moment you are in the market. That is the subject of the next chapter. Chapter 2. The Psychology of the Individual Trader. If you could take every lesson in this book and reduce it to a single sentence, that sentence would be this: the greatest enemy you will ever face in the market is not the market, it is yourself. Elder writes this not as a motivational phrase, but as a clinical observation, drawing on his years of practice as a psychiatrist and his years of experience as a trader. The psychological dimension of trading is not merely important, it is primary. Everything else, the charts, the indicators, the systems, the money management rules, all of it is secondary to the quality of the mind sitting behind the screen. Consider the trader who has developed a solid system. The rules are clear. The backtesting is positive. The logic is sound. When this trader runs the system on paper, the results are excellent. But when real money is involved, the results are terrible. The trader second-guesses signals. They exit winning trades early when profits appear because fear of losing those profits overwhelms the rational plan. They hold losing trades because admitting the loss means admitting they were wrong. In every case, the deviation from the system, driven by emotion, leads to losses. The system was not the problem. The psychology was the problem. This experience is shared by the vast majority of traders. They know what they should do. They have the rules. But in the heat of a live trade, with real capital on the line and the chart moving against them, the emotional brain takes over from the rational one. And the emotional brain, shaped by evolution to seek immediate reward and avoid immediate pain, is catastrophically ill-suited to trading. Elder draws a deeply insightful comparison between trading addiction and other forms of destructive behavior. During his years of psychiatric practice, he worked with many patients struggling with addiction. He observed that the patterns of addictive behavior in those patients were strikingly similar to the patterns he later observed in struggling traders. The person with an addiction knows their behavior is destructive. The struggling trader knows their impulsive trading is destroying their account. But knowing is insufficient. The pull of the behavior, the emotional reward of the action, is too immediate and too powerful to be overcome by abstract rational knowledge alone. The solution that recovery programs use is not to give members more information about why their habit is harmful. They already know that. The solution is to build an entirely new structure of daily habits, accountability mechanisms, and support systems that change the conditions under which decisions are made. Elder argues that traders need the same structural approach, not just more knowledge, but a framework of rules and records and honest self-assessment that prevents the emotional mind from overriding the rational one when the pressure is highest. One of the most destructive emotional forces Elder examines is the fear of being wrong. In ordinary life, being wrong is uncomfortable, but not usually catastrophic. In trading, being wrong costs money. Real money that represents real work and real-life plans. The emotional weight of that fact is enormous, and most traders respond to it in ways that make their situation worse rather than better. The most common response is denial. A losing trade is not closed because closing it means acknowledging the loss, and acknowledging the loss means being wrong. So the trader holds, hoping the market will eventually prove them right. Sometimes it does, and the lesson learned is exactly the wrong one. The trader learns that holding losing trades and hoping is a valid strategy. So next time, they hold even longer. And eventually, the trade that does not come back does serious damage. The second destructive response is revenge trading. After a loss, the emotional brain wants to recover what was taken. The trader jumps into another trade immediately, not because the setup is sound, but because they want to get back to even quickly. This urgency bypasses every rule of the trading system and typically produces another loss, which creates more urgency, which produces more losses, in a spiral that can destroy an account in a single session. The third response is overconfidence after a winning streak. When a trader strings together a sequence of profitable trades, they begin to feel invincible. They increase position sizes, take riskier setups, and abandon the careful discipline that produced the winning streak in the first place. The market, which is entirely indifferent to the trader's confidence, delivers the kind of loss that erases not just the gains of the streak, but sometimes a large portion of the underlying capital as well. Against all of these traps, Elder offers a set of practical disciplines. The first and most important is the trading journal, not merely a record of trades, but a detailed document of the emotional state before, during, and after each trade. What was the reason for entering? What did it feel like when the chart moved against the position? What decision was made, and why? Over weeks and months, this journal reveals patterns that would be completely invisible without it. The trader begins to see clearly which emotional states lead to which kinds of bad decisions, and that awareness is the foundation of genuine change. The second discipline is the development of rules so specific and unambiguous that they remove active decision-making from moments of high emotional pressure. If the rule says to exit when the stop-loss level is reached, there is no decision to make in that moment. The decision was already made, calmly and rationally, before the trade was entered. Building the habit of following rules over the habit of following feelings is one of the most challenging and most transformative things a trader can do. The third discipline is a daily self-assessment before trading begins. Before opening a single chart, the trader checks in honestly with their own state of mind. Are they calm and analytical? Are they well-rested and clear-headed? Or are they feeling the pressure of yesterday's losses, the excitement of yesterday's gains, the anxiety of a difficult personal situation? If the honest answer indicates that the emotional state is not suitable for trading, the right decision is simply not to trade that day. The market will always be there tomorrow. Capital that is thrown at the market in a disturbed emotional state may not be. Chapter 3. Mass Psychology and the Behavior of the Crowd. Every single price on every single chart in the world is the product of a human decision. Behind every buy order is a person who chose to buy. Behind every sell order is a person who chose to sell. And those people, in their millions, operating across every market in the world, are not making their decisions in isolation. They are influenced by each other, by news and opinion, by the movement of prices themselves, and by the deep social instincts that have shaped human behavior across thousands of years of evolution. The result is crowd psychology, and understanding it is one of the most important things any trader can do. Elder explains that the market is not merely a random collection of individual choices. It is a social organism. Prices move the way they do because groups of people are feeling specific things at specific times, and those feelings translate into buying and selling behavior that follows recognizable patterns. Fear creates sellers. Greed creates buyers. Hope keeps losing positions alive. Panic closes them at exactly the worst moment. These are not occasional distortions of an otherwise rational system. They are the system itself, and the trader who grasps this has a fundamental edge over those who do not. Think about what happens in a market that has been rising steadily for a long period. As prices climb, more people begin to notice. Friends and colleagues talk about their gains. Articles celebrate the strength of the market. Each new story of success draws more participants in. The rising price itself becomes proof that buying is the right thing to do. Everyone is buying, so buying must be correct. This is the crowd in full momentum, a self-reinforcing cycle of optimism feeding on itself. The people entering at this stage are generally not the experienced professionals. The professionals bought much earlier, when prices were lower and the news was uncertain and nobody was celebrating anything. The latecomers, drawn in by excitement and the fear of missing an opportunity, are buying precisely as the most experienced participants are beginning to exit. They are the fuel that the professionals sell into. When the reversal comes, as it always does, it tends to be swift and harsh. The price begins to fall. At first, the crowd interprets it as a temporary dip, a buying opportunity within an ongoing uptrend. They hold their positions, reassuring themselves with fundamentals and long-term thinking. But as the price continues to fall, fear replaces optimism. Stories that once celebrated the market now warn of danger. One by one, and then in accelerating waves, holders become sellers. The selling pushes prices lower, which creates more fear, which creates more selling, in a spiral that mirrors the earlier optimism exactly, but in the opposite direction. Elder observes that this cycle, from optimism through euphoria, through complacency, through fear, through panic, through despair, and back again, is one of the most durable and predictable patterns in all of financial history. It has played out in every major market boom and bust across centuries. The specific assets change. The underlying human emotions do not. And for the trader who can identify where the crowd sits in this emotional cycle, there is opportunity at every stage of it. The challenge is that the crowd always feels correct in the moment. When everyone is buying and prices are rising and the news is positive, it feels deeply irrational to step back and suggest the market is dangerously extended. The social pressure to align with the majority is enormous. The discomfort of going against the prevailing sentiment is real. Overcoming this requires a specific kind of trained independence, supported by the analytical tools that allow the trader to see what the crowd is doing and anticipate where that behavior leads. This is where technical analysis enters the picture. Every candlestick on a chart, every bar, every price movement represents a moment in the battle between buyers and sellers. By learning to read those patterns, a trader develops a reliable intuition for where the crowd is emotionally and where it is likely to go. Not through prediction, but through pattern recognition, applied to the consistent historical record of human behavior under financial pressure. The tools of that pattern recognition are the subject of the chapters that follow, beginning with the fundamental language of the chart itself. Chapter 4: Reading Charts and Classical Technical Analysis. The language of the financial market is price. Every piece of information that exists about a stock, a currency, a commodity, or any other tradable instrument eventually finds its way into the price. Earnings reports, central bank decisions, geopolitical events, technological disruptions, shifts in consumer behavior, all of it is absorbed by the market and reflected in what participants are willing to pay. The price is the final and complete summary of everything the market collectively knows and feels at any given moment. Technical analysis is the discipline of reading that summary. It does not ask why prices are moving. It asks where they have been and, based on that history, where they are statistically likely to go. It works not because charts are magical or because the future is predetermined, but because human beings behave in consistent ways under consistent emotional conditions. The patterns that appeared in markets a century ago appear again today because the psychology driving them, fear, greed, hope, and denial, has not changed. A chart is a visual record of price movements over time. The line chart connects closing prices in a continuous line, giving a clean overview of the overall direction. The bar chart shows, for each time period, the opening price, the closing price, the highest point reached, and the lowest point reached. The candlestick chart conveys the same information in a visual format that makes the relationship between buyers and sellers immediately readable. A tall white candle, where price closed much higher than it opened, tells you the buyers dominated that period completely. A tall dark candle tells you the sellers were firmly in control. A small candle, with long shadows above and below, tells you neither side achieved dominance, and the market was genuinely uncertain. Above the level of individual candles, patterns emerge over multiple trading sessions. Support is a price level where buyers have historically been willing to step in and prevent further decline. Resistance is a price level where sellers have historically become active enough to halt further advances. These levels are not arbitrary. They exist because of the psychology of the participants who created them. When a large number of traders bought at a certain price and then watched that price fall below their entry, they are sitting on losses. Their natural instinct is to wait until the price returns to their original entry level, where they can exit without realizing a loss. When the price does eventually return to that level, they place sell orders in large numbers, creating the resistance that any new buyers must absorb. Support is formed by a similar psychology. Traders who missed the original move or sold prematurely, waiting to buy again at a price they previously found attractive. Understanding support and resistance as the preserved record of past emotional decisions, waiting to influence future behavior, is one of the most practically useful insights in all of technical analysis. A support level that has been tested multiple times and held each time becomes increasingly significant because each test adds more traders who know about it and have organized their own decisions around it. Trends are the most fundamental pattern in all of technical analysis and represent the clearest expression of the crowd's dominant emotion at any given time. In an uptrend, the crowd is predominantly optimistic, each new high a confirmation of that optimism. In a downtrend, pessimism dominates, each new low a reflection of spreading fear. In a sideways market, the crowd is genuinely divided, unable to commit to a direction, balanced in a standoff that will eventually break decisively one way or the other. The concept of trend lines, drawn across the successive lows of an uptrend or the successive highs of a downtrend, provides one of the simplest and most powerful tools for identifying whether a trend is intact or breaking down. As long as an uptrend's price stays above its rising trend line, the trend is healthy. When price breaks below that line with conviction, it is a warning that the emotional foundation of the trend is changing. Learning to draw and read trend lines accurately is one of the first and most important skills a trader can develop. Chart patterns, the formations that price creates as it moves through its cycles, have been observed, named, and studied for well over a century. Head and shoulders. Formations, double tops and double bottoms, triangles, flags, wedges. These are not decorative names given to interesting shapes on a chart. They are visual representations of specific emotional situations within the crowd, specific configurations of fear and greed that have historically tended to resolve in particular and predictable ways. Learning these patterns is learning the grammar of the market's language, and with it comes the ability to read sentences in price behavior that the untrained eye sees only as noise. Chapter 5: Technical Indicators and How to Use Them. A technical indicator is a mathematical formula applied to price data and sometimes to volume as well, with the purpose of transforming raw price information into a clearer and more immediately actionable signal. Indicators are designed to cut through the noise of daily price fluctuations and give the trader a clearer picture of the underlying trend, how strong it is, when it is likely to change direction, and when the risk of being in the market is elevated versus when conditions favor entry. Elder is both a creator and a sophisticated interpreter of technical indicators, having developed several of his own that have become widely used throughout the trading world. Before examining the specific tools, he provides a framework for understanding what indicators are trying to do and what their inherent limitations are. Indicators divide into two broad categories: trend-following indicators and oscillators. Trend-following indicators are designed to tell you the direction and strength of the current trend. They work beautifully when the market is moving with conviction in one direction, generating reliable signals that keep the trader on the right side of a sustained move. They become unreliable in sideways markets, where prices cross back and forth without committing to a direction, generating what are called whipsaw signals, repeated false entries that produce a succession of small losses. Oscillators are designed to identify when the market has moved too far in one direction and is likely to pull back. They measure the degree to which price has become stretched beyond normal levels, identifying overbought conditions where the buying has been excessive and oversold conditions where the selling has been excessive. Oscillators work best in ranging markets where prices are oscillating between defined levels. In strongly trending markets, they can give premature reversal signals, suggesting the market is overbought, when in fact it is simply in a powerful uptrend that will continue for much longer than the oscillator indicated. This is precisely why Elder insists that no single indicator should ever be used in isolation. The combination of a trend-following indicator with an oscillator, each designed to work well in different conditions, creates a system that is far more reliable than either tool alone. When both the trend direction, confirmed by the trend-following indicator, and the timing provided by the oscillator are pointing in the same direction, the probability of a profitable trade is substantially higher. The moving average convergence. Divergence indicator, known widely by its abbreviated name, MACD, is one of the most powerful trend-following indicators available. It is constructed from the relationship between two exponential moving averages of different lengths. When the faster average rises above the slower one, it signals a potential buying opportunity. When it falls below, it signals a potential selling opportunity. The MACD histogram, which plots the difference between the two averages as a series of bars, provides additional information about the momentum of the trend. Growing histogram bars indicate an accelerating trend. Shrinking bars indicate fading momentum, often an early warning of a coming reversal. Elder identifies divergences between the MACD histogram and price as among the most powerful signals in technical analysis. A bullish divergence occurs when price makes a new low, but the MACD histogram makes a less extreme low than it did at the previous trough. This tells you that, although the sellers are still in control of price, their momentum is weakening. The downward force is exhausting itself. A bearish divergence at the top of an uptrend delivers the opposite message. Price reaches a new high, but the histogram records a lower peak than it made at the previous high, warning that the upward momentum is fading even as price itself pushes into new territory. The Elder Ray Index is one of the author's own creations. It measures the relative power of buyers and sellers in the market by comparing current prices to a moving average of recent prices. The indicator has two components. Bull power measures the distance between each period's highest price and the moving average, reflecting how far above the average the most enthusiastic buyers push the price. Bear power measures the distance between each period's lowest price and the moving average, reflecting how far below the average the most aggressive sellers push the price. When bull power is positive and growing, buyers are confidently in control. When bear power is negative but moving towards zero, sellers are weakening and a buying opportunity may be approaching. The force index is another of Elder's creations and is perhaps his most elegant. It combines price movement with volume to measure the force or conviction behind any given price move. The formula multiplies the change in price from one period to the next by the volume during that period. A large price advance on heavy volume produces a strongly positive force index reading, confirming that the buying pressure behind the move is substantial and authentic. A price advance on declining volume produces a weak force index reading, suggesting the move lacks genuine support and may be vulnerable to reversal. The Relative Strength Index, created by analyst J. Wells Wilder decades ago, and still one of the most widely used oscillators in the world, compares the average magnitude of recent gains to the average magnitude of recent losses to produce a reading between 0 and 100. Readings above 70 generally indicate an overbought market. Readings below 30 indicate oversold conditions. Elder's treatment of this indicator goes well beyond these basic levels, focusing especially on divergences between the RSY and price as the indicator's most reliable and most valuable signals. Throughout this chapter, Elder returns to the principle that runs through the entire book. Technical indicators are not oracles. They are tools, and like all tools, they work best in the right conditions and produce poor results in the wrong conditions. The professional trader does not search for a magic indicator that works in all markets at all times. The professional understands the strengths and limitations of each tool available, combines multiple tools in a way that compensates for the weaknesses of each, and trades only when the evidence from several independent sources is pointing in the same direction. Chapter 6: Moving Averages and the Science of the Trend. At the heart of most effective trading approaches lies a clear and honest assessment of the trend. The trend is not merely a direction on a chart. It is the market's statement about the dominant collective emotion of its participants at this moment in time. When the trend is upward, optimism is the governing emotion. When the trend is downward, pessimism has taken control. When the trend is sideways, genuine uncertainty has created a standoff between buyers and sellers that has not yet been resolved. Moving averages are the simplest, most widely used, and most practically effective tools for identifying trends. Elder gives them extended treatment not because they are sophisticated, but precisely because they are not. In trading, the simpler the tool and the more consistently it can be applied, the more valuable it tends to be over time. The more complex a system becomes, the more opportunities it creates for subjective interpretation, which is another way of saying the more opportunities it creates for emotion to interfere. A simple moving average is calculated by adding the closing prices of a defined number of past periods and dividing by that number. A 20-day simple moving average takes the closing prices of the past 20 trading sessions, adds them together, and divides by 20. As each new session concludes, the most recent price is added and the oldest price drops off, so the average moves continuously forward through time. When prices sit above this average, the short-term trend is upward. When they sit below it, the trend is downward. The angle of the average itself, whether it slopes upward, downward, or runs flat, provides additional information about the energy within the trend. The exponential moving average improves on the simple version by weighting recent prices more heavily than older ones. The result is an average that responds more quickly to current market conditions while still smoothing out the noise of individual sessions. Elder tends to prefer exponential moving averages precisely because of this greater responsiveness, which makes them more useful for identifying trend changes in a timely way. One of the most important insights Elder offers about moving averages is their role as dynamic support and resistance levels. In a strong uptrend, price does not typically move in a straight line upward. It advances, pauses, pulls back toward the moving average, finds support there, and then advances again. Each time the moving average holds as support and price bounces from it, the significance of that level grows in the minds of market participants. Over time, a widely watched moving average becomes a level that traders actively organize their decisions around, creating a self-reinforcing dynamic where the level holds precisely because so many traders expect it to. The slope of the moving average is a detail that many traders overlook, but that Elder considers critically important. A sharply rising moving average tells you that the trend is not just present, but accelerating. A flattening moving average warns that the trend is losing momentum even before that loss becomes obvious in the price itself. A moving average that begins to slope downward is one of the earliest signals that a change of trend may be underway. Watching these changes in slope gives the trader advance notice of potential turning points that they would otherwise miss. The use of multiple moving averages of different lengths on the same chart provides a richer picture of the trend's structure. A short-term average, a medium-term average, and a long-term average, when all three are aligned in the same direction and spaced apart with the shortest on top in an uptrend and the longest below, create what is often called an aligned or stacked moving average formation. This alignment confirms that the trend is healthy across multiple time horizons simultaneously and provides one of the most reliable confirmations of a strong directional move. The crossover of a shorter moving average above or below a longer one is among the most classic signals in technical analysis, and Elder discusses it both for its value and for its limitations. When a short-term average crosses above a longer one, it suggests that recent momentum has shifted bullishly relative to the longer-term direction. When it crosses below, the momentum has shifted bearishly. The limitation is that these crossovers always lag the actual turning point of the market by some degree, since both averages are based on past prices. Used alone, crossover signals arrive late. Used as confirmation within a broader analytical framework, they add meaningful weight to the overall picture. Chapter 7: Oscillators, Timing, and the Rhythm of the Market. If moving averages are the tools that tell you where the market is going, oscillators are the tools that tell you when the market has gone too far and is likely to pause or reverse. Together, they form a complementary pair that addresses the two most important questions in trading: direction and timing. An oscillator is a mathematical calculation applied to price data that produces a value oscillating between defined upper and lower limits. When the oscillator reaches the upper boundary, the market is described as overbought. Buyers have pushed price too far above its natural resting level, and a pullback toward the mean is probable. When the oscillator reaches the lower boundary, the market is oversold. Sellers have pushed price too far below its natural level, and a bounce is probable. These extremes are not guaranteed reversal points, but they identify moments when the risk-reward of a trade against the recent direction is becoming favorable. The stochastic oscillator measures where the current closing price sits relative to the range of prices over a recent period. If the most recent close is near the top of the recent range, the stochastic is high, suggesting the market is approaching overbought conditions. If the close is near the bottom of the recent range, the stochastic is low, suggesting oversold conditions. The indicator consists of two lines whose crossover within these extreme zones generates trading signals: a bullish crossover in oversold territory, suggesting a potential buy; a bearish crossover in overbought territory, suggesting a potential sell. Elder finds the stochastic particularly valuable in ranging markets, where prices are bouncing predictably between defined support and resistance levels. In this environment, the stochastic's readings closely correspond to the turning points at the edges of the range, and the signals it generates can be followed with reasonable confidence. In a strongly trending market, he cautions against relying on the stochastic's overbought readings as sell signals, because in a genuine uptrend, the stochastic can remain in overbought territory for extended periods, and exiting a good trend-following position because the stochastic looks stretched is one of the most common and most costly errors that trend traders make. The divergence is the oscillator signal that Elder emphasizes above all others. When price makes a new high, but the oscillator, in measuring the underlying momentum of that move, records a less extreme high than it did at the previous peak, something important is being revealed. Price appears to be advancing, but the energy driving the advance is diminishing. The crowd is still buying, but fewer of them, with less conviction than before. This is a bearish divergence, and it is one of the most reliable early warnings available that a trend is running out of fuel. The bullish divergence at the bottom of a downtrend is its mirror image. Price makes a new low, suggesting the bears are still firmly in control. But the oscillator, measuring the momentum of the selling, shows a less extreme low than it registered at the previous trough. The selling pressure is weakening, even as price itself pushes into new low territory. This divergence between what price is doing and what underlying momentum is doing is a powerful signal that the selling is exhausting itself and that the balance is shifting toward the buyers. Elder is careful to note that divergences are not guaranteed reversal signals. A bearish divergence can persist through multiple new price highs before the market finally turns. A bullish divergence can develop and then be followed by further declines before the bottom is established. The value of divergences lies not in their certainty, but in their probabilistic edge, the fact that they shift the odds meaningfully in the direction of the divergence at a time when most market participants are still fully committed to the prevailing trend and therefore caught off guard when the reversal comes. The Williams percent range is another oscillator Elder discusses, functioning similarly to the stochastic but inverted in its presentation. Like the stochastic and the RSI, its greatest value is in identifying divergences and extreme readings rather than in mechanical application of simple overbought and oversold levels. Elder's consistent message across all oscillator discussions is that these tools are most useful when they are telling you something different from what price itself is showing you. Alignment between price and oscillator is reassuring, but not particularly actionable. Divergence between them is where the real opportunity lies. Chapter 8. Volume, Open Interest, and Market Breadth. Price tells you what the crowd is doing. Volume tells you how enthusiastically and how broadly they are doing it. These two pieces of information together create a far more complete picture of market behavior than price alone can provide. Elder devotes significant attention to volume analysis precisely because it is so widely ignored by traders who look only at price, and its neglect creates an edge for those willing to learn to use it properly. Every transaction in the market requires both a buyer and a seller. Volume measures the total number of units exchanged during a given period. High volume means that many participants were actively engaged, that significant disagreement about current value existed and was resolved through exchange. Low volume means that few participants were engaged, and whatever price movement occurred happened in a relatively thin and uncommitted environment. In a healthy uptrend, volume should expand on rising price days and contract on declining price days. This pattern tells you that the buyers are enthusiastic and numerous, that they are committing increasing amounts of capital to each new advance, while the sellers who emerge during temporary pullbacks are a smaller, less committed group. When this relationship is intact, the uptrend has the authentic support it needs to sustain itself. When this relationship begins to break down, the warning it provides often precedes the price signal by days or even weeks. When prices continue to rise, but volume on advancing days begins to shrink, it means the buyers are becoming fewer and less committed, even as price maintains its upward appearance. The crowd of buyers is thinning. The advance is becoming hollow. The price may continue higher for some time on the inertia of the existing trend, but the foundation beneath it is deteriorating. Volume is telling the truth that price has not yet acknowledged. The concept of the climax is one of Elder's most vivid descriptions in the volume section. A climax is a period of extremely high volume, accompanied by wide price swings and intense emotional activity. At the top of a long bull market, the climax often manifests as a period of frantic and widespread buying, with prices surging on enormous volume and news coverage reaching a fever pitch of celebration. At the bottom of a severe bear market, the climax takes the form of mass panic selling, prices plunging on the heaviest volume of the entire decline as the last remaining holders capitulate to fear. These climax periods are significant precisely because they represent the moment when the dominant emotion, whether ecstasy at a top or despair at a bottom, has reached its absolute maximum intensity. After a buying climax, there are very few people left who have not yet bought. After a selling climax, there are very few sellers left who have not already sold. With the dominant force exhausted, the conditions are set for a reversal, or at minimum, a prolonged period of sideways consolidation. Open interest, a concept specific to futures and options markets, measures the total number of contracts outstanding at any given moment, contracts that have been entered into but not yet closed. Rising open interest in a futures uptrend means new money is flowing into the market, with new buyers opening new long positions and new sellers willing to take the opposite side. This combination of rising price, rising volume, and rising open interest is the ideal confirmation of a genuinely strong and broadly supported move. Falling open interest in an uptrend suggests that the advance is being driven by the closing of existing short positions rather than by fresh buying conviction, which is a weaker and less sustainable form of buying pressure. The advance decline line, a measure of market breadth primarily applicable to stock market analysis, tracks the running cumulative difference between the number of advancing stocks and the number of declining stocks on any given day. When this line is moving in the same direction as the major market averages, the breadth of the market is confirming the index trend. When the major averages are making new highs, but the advanced decline line is failing to reach corresponding new highs, it warns that the rally is narrowing, that fewer stocks are participating, that the bull market is becoming concentrated in a small number of large names, while the broader market quietly deteriorates. This kind of breadth divergence has historically preceded major market tops. Chapter 9. The Triple Screen Trading System. Everything that has been discussed so far, the psychology of the trader and the crowd, the tools of chart analysis, the indicators, the role of volume, must ultimately be organized into a practical decision-making framework. Knowledge that exists as isolated pieces is far less useful than knowledge that has been synthesized into a coherent system, telling you clearly and consistently when to enter, when to exit, and how much to risk. The triple screen trading system is that synthesis, and it is one of the most practical and effective trading frameworks ever developed for individual traders. The central insight of this system is that every market exists simultaneously on multiple timeframes, and these different timeframes often tell very different stories. The hourly chart shows a picture that may look completely different from the daily chart, which may in turn look different from the weekly chart. The trader who looks at only one of these timeframes is seeing only one piece of a much larger puzzle. They may be entering a trade that looks perfect on their chosen chart, but that is running directly against a powerful trend on a larger timeframe, setting them up for a loss that they will attribute to bad luck. But that was actually the entirely predictable result of incomplete analysis. The first screen is called the tidal wave screen because it corresponds to the largest timeframe in the analysis, the one that reveals the major current of the market, just as the tide is the dominant force governing water movement regardless of smaller waves. The trader begins by examining a chart at a time frame, one order of magnitude larger than the one they intend to trade. If the plan is to trade on the daily chart, the first screen is the weekly chart. If the plan is to trade on the hourly chart, the first screen is the daily chart. On this largest time frame, the trader identifies the dominant direction of the trend using a trend-following indicator, such as the MACD histogram or a sloping moving average. The result of this first screen is a simple but absolutely binding directive. If the major trend is up, only long trades will be considered for the duration of this analysis. If the major trend is down, only short trades will be considered. If the major trend is sideways with no clear direction, the system advises stepping aside entirely, as trading without a clear trend is statistically much more likely to produce losses than a consistently directional market. The second screen, called the wave screen, operates on the intermediate time frame, the one the trader is actually planning to trade. Here, the trader is not looking for further trend confirmation. The trend was already established on the first screen. Instead, the trader is looking for temporary counter-trend moves within that major trend, pullbacks within an uptrend, or rallies within a downtrend that offer better entry opportunities than buying at the most recent high or selling at the most recent low. To identify these counter-trend extremes, the second screen uses an oscillator rather than a trend-following indicator. The trader watches for the oscillator to move into oversold territory during a pullback within an uptrend, or into overbought territory during a rally within a downtrend. When this happens, the intermediate move is showing signs of exhausting itself, setting up conditions favorable for the major trend to resume. The third screen, called the ripple screen, operates on the shortest time frame, below the intermediate chart. Its purpose is to provide the precise entry signal at the most favorable possible price. Having established the major trend direction on the first screen and identified a favorable entry timing on the second screen, the trader now watches the short-term chart for a specific trigger, a breakout above a recent minor resistance level for a long trade, or a breakdown below a recent minor support level for a short trade. This is the moment of execution. The power of this three-screen approach is the layering of probabilities it creates. Trading in the direction of the major trend addresses the most powerful force operating on the market. Entering after a counter-trend correction takes advantage of a better price than would be available by entering at the height of the trend. Executing on a specific short-term breakout provides a precise and defined entry point with a clear invalidation level close enough to allow a tight stop loss and therefore a favorable reward-to-risk ratio. Stop-loss placement in the triple screen system is precise and non-negotiable. In a long trade entered after a pullback to support in an uptrend, the stop-loss is placed just below the most recent swing low on the intermediate chart. If price reaches that level, the trade thesis is proven wrong. The pullback has become something more serious. The loss is taken immediately and completely, with no negotiation and no hope. If price does not reach that level, but instead begins to move in the intended direction, the trade is managed according to the profit-taking rules of the system, either a trailing stop that locks in gains as the trend continues, or a predefined target level based on the next significant resistance. The triple screen trading system is not perfect. No system can be. But it is logically coherent, practically tested, and deeply aligned with the way markets actually behave. It respects the hierarchy of timeframes. It trades with the major trend while entering at advantageous prices within it. It uses a combination of trend following and oscillator tools that compensate for each other's weaknesses, and it provides precise enough rules to prevent the emotional brain from taking over at the worst possible moments. Chapter 10: Risk Management and the 2% Rule. All of the knowledge discussed so far, every psychological insight, every charting technique, every indicator and system can be completely undone by a single fundamental failure. That failure is the failure to manage risk. Elder states this plainly and repeatedly because it is the most important practical truth in all of trading. Technical analysis determines which trades to take. Money management determines whether you survive long enough to take them. The financial markets are patient and pitiless in their punishment of traders who do not respect risk. You can have the best analytical mind in the room, the most refined trading system, the deepest understanding of market psychology, and if you risk too much on any single trade, a run of losses will end your trading before your system has had the chance to demonstrate its worth over an adequate sample size. A depleted account means the game is over. There is no coming back from zero. The foundation of Elder's money management philosophy is what he calls the 2% rule. The rule is simple in its statement and profound in its mathematical implications. Never risk more than 2% of your total trading capital on any single trade. The risk is defined as the dollar distance between the entry price and the stop loss, multiplied by the position size. If the account contains 10,000 units of currency, the maximum risk on any single trade is 200 units. The mathematical power of this rule becomes immediately clear when you consider loss sequences. At 2% risk per trade, it would require 50 consecutive losing trades to lose the entire account. 50 consecutive losses is statistically so improbable with any reasonably tested system that it essentially never occurs in practice. The 2% rule does not promise that every trade will win. It promises that no sequence of inevitable losses will be fatal. It keeps you in the game. Traders, especially those new to the discipline, often resist the 2% rule as too conservative. They believe that larger positions will generate wealth faster. And in the short term, during a winning streak, they are right. But one bad streak with 10% per trade, a sequence of only 10 consecutive losses, would eliminate nearly 2/3 of the account. The same 10 losses at 2% per trade would reduce the account by approximately 18%, which is painful but completely survivable and recoverable. The 6% rule is the companion principle operating at the portfolio level. If the account loses 6% of its value in any single month, trading stops for the remainder of that month. 6% in a month is a signal that something is wrong, either with the trading system, with the market environment, or with the trader's own psychological state and decision quality. The purpose of stopping is to prevent a bad month from becoming a catastrophic one. It preserves enough capital that the trader can begin the next month with a still viable account and, crucially, with a clear mind that has had time to diagnose and correct whatever caused the losses. Position sizing is the practical mechanism through which the 2% rule is applied to every trade. Before entering any position, the trader calculates the distance between the intended entry and the stop-loss level. This distance, multiplied by the planned position size, must not exceed 2% of the account. A trade with a tight stop-loss can accommodate a larger position. A trade with a wide stop-loss requires a proportionally smaller one. The position size is never determined by how confident the trader feels or how much profit they hope to make. It is always determined by where the stop-loss is and how much of the account can be risked. This approach creates an important and often overlooked relationship between the quality of the entry and the quality of the trade. A well-timed entry, placed close to a meaningful support level so that the stop-loss can be placed just below it, allows a larger position for the same risk budget than a poorly timed entry that requires a wide stop to give the trade room to work. The better the technical analysis and the more precise the entry, the more capital can be deployed in a single trade without increasing the dollar risk. Analytical precision is directly rewarded through the sizing mechanism. The reward-to-risk ratio is another central concept in Elder's money management framework. For every trade taken, the expected profit if the trade works expressed as the distance from the entry to the intended target, should be compared to the expected loss if the trade fails, expressed as the distance from the entry to the stop loss. Elder recommends accepting only trades where the expected reward is at least 3 times the expected risk. A minimum 3-to-1 ratio means that a trader can be wrong on more than 2 out of every 3 trades and still break even, or wrong on fewer than 2 out of 3 and be consistently profitable. Many successful trading systems operate with win rates well below 50%. This seems counterintuitive until you absorb the mathematics fully. At a 3-to-1 reward-to-risk ratio, with a win rate of only 40%, the system is profitable. For every 10 trades, the trader wins 4 and loses 6. The 4 wins each return 3 units. The 6 losses each cost 1 unit. The total result is 12 units of profit against 6 units of loss, a net gain of 6 units. The minority of winning trades more than compensates for the majority of losing ones, provided the ratio is maintained with discipline. The stop loss itself is the most psychologically demanding element of money management because it forces the trader to admit they were wrong. Every time a stop loss is hit and a loss is taken, the emotional brain experiences something very close to pain. The instinct is to override the stop, to hold just a little longer, to give the trade one more chance to come back. This instinct must be trained out of existence. The stop loss is not a suggestion. It is not a guideline. It is the line beyond which the original trade thesis has been proven incorrect. And once that line is reached, the professional exits without hesitation, takes the defined loss, and immediately begins looking for the next good opportunity with fresh eyes and an intact capital base. Chapter 11. Developing your trading system and plan. All the psychology, chart reading, indicators, and money management principles discussed throughout this book must ultimately be assembled into one coherent, documented, and personally tested structure, your own trading system and trading plan. Without this synthesis, the individual pieces of knowledge remain interesting but unconnected, impossible to apply with the consistency that profitable trading requires. The trading system is the complete set of rules that defines every aspect of how you trade. The trading plan is the application of those rules to your specific situation, your account size, your available time, and your realistic financial goals. Elder is precise about what a trading system must contain. It must specify exactly which conditions must be simultaneously present for a trade to be considered. Which indicators must give which signals? On which timeframes? With what level of agreement between them required before a trade is initiated? The rules must be specific enough that 2 different traders, given the same chart data, would reach the same conclusion about whether a valid trade signal exists. If reasonable people can disagree about the interpretation of the rules, then they are not truly rules at all. They are invitations to rationalize whatever the emotional mind wants to do in the moment. Entry rules define the precise trigger that initiates a trade. In a triple screen framework, for example, the weekly MACD histogram must be rising, confirming an uptrend on the major time frame. The daily oscillator must have moved into oversold territory, confirming a pullback within that uptrend. And on the hourly chart, a price breakout above the most recent minor resistance level provides the final execution trigger. All 3 conditions must be present simultaneously. If only 2 of the 3 are met, no trade is taken, regardless of how attractive the setup looks on any single screen. Exit rules are even more important than entry rules, and Elder is emphatic about this. Beginning traders think intensely about entries and barely consider exits. Professional traders know that exits, both protective stops and profit-taking decisions, are where the real financial outcome of trading is determined. There are 2 categories of exit, and both must be specified in advance. The protective stop-loss exit defines the exact price level at which a losing trade will be closed. The profit-taking exit defines the conditions under which a winning trade will be closed. The protective stop loss is the more critical of the two. It represents the level at which the original trade thesis is proven wrong, the point beyond which continuing to hold the position cannot be justified by any analysis. For a long trade entered on a pullback to support in an uptrend, the stop is placed just below that support level. If support breaks, the trade is wrong. Period. The loss is taken immediately and completely. There is no waiting for one more candle, no adjustment of the stop further down, no hope that the market will recover. For the profit-taking exit, several approaches exist within a disciplined framework. A trailing stop moves in the direction of the trade as it becomes profitable, protecting an increasing portion of the gain while still leaving room for the trend to continue. A fixed target places the exit at a specific price level corresponding to the next meaningful resistance in an uptrend or support in a downtrend. A time stop closes the trade after a defined number of sessions if the expected movement has not yet occurred, on the logic that a trade that sits still is probably not the setup that was anticipated, even if it has not yet reached the stop-loss level. The trading plan addresses the questions of context and personal circumstance that surround the system. How much time is available each day to monitor and analyze markets? Which markets and instruments are to be traded? What is the account size, and what are the specific financial objectives? How will losing streaks be managed emotionally? These questions are not incidental. They are foundational, because a system that requires 3 hours of daily chart analysis cannot be executed by someone with 1 hour available, and the attempt to squeeze a 3-hour process into 1 hour is an invitation to shortcuts that undermine the system's integrity. The trading plan also contains equally important rules about when not to trade. Elder emphasizes this with particular force. The best traders are highly selective. They do not feel compelled to participate in every market session. They know precisely the conditions their system is designed to exploit, and when those conditions are not present, they wait without frustration or restlessness. Rules about not trading in choppy sideways markets, not trading immediately before major scheduled economic announcements, not trading when personal emotional stress is elevated, not trading after reaching the monthly 6% stop-out. These restraints are as essential to long-term performance as the rules for when to trade. Paper trading, the practice of tracking trades in a simulated environment without real capital at risk, is Elder's recommended starting point for any new system. It allows the trader to test the system in live market conditions, observe its performance across different market environments, and build genuine conviction in the rules before the psychological weight of real money amplifies every decision. Only after accumulating enough paper-traded evidence to have confident, evidence-based faith in the system's logic should real capital be deployed. And even then, beginning with smaller position sizes than the money management rules would allow is a sound practice during the transition. Chapter 12. The Trading Diary and the Path to Continuous Improvement. Among all the practical recommendations Elder makes in this book, the Trading Diary may be the one that creates the most transformative and lasting impact on a trader's development. It is not just a record of trades, it is a comprehensive document of the trader's thinking, feeling, and behavior at every stage of every trading decision. And its purpose is not administrative. It is the primary tool for developing the self-awareness, without which every other skill and technique in this book remains incomplete. The pre-trade section of every diary entry is written before the trade is entered. It documents the specific technical reasons for the trade, which indicators generated which signals, what the broader market context looks like, where the stop-loss will be placed and why, and what the planned target is. It also includes an honest statement of the trader's current emotional state, because that state is a direct input into the quality of the decision being made and must be tracked just as carefully as any chart pattern. The post-trade section is written after the trade is closed. It records the actual outcome, the entry and exit prices, and the profit or loss. More importantly, It contains a candid evaluation of the execution quality. Was the entry taken for the precise reasons specified in the pre-trade entry, or did emotion introduce some deviation? Was the stop loss honored immediately when hit, or was there hesitation? Was the profit-taking exit in accordance with the plan, or did fear prompt an early exit? These are the questions whose honest answers are the raw material of genuine learning. Over weeks and months, the trading diary becomes one of the most revealing documents a trader will ever possess. Patterns emerge that are invisible to any trader who operates without one. A consistent tendency to trade poorly on the final session of each week might reveal an emotional pressure to end the week profitably that distorts decision quality. A pattern of exiting winning trades at roughly half the intended target might reveal a fear of giving back profits that is costing far more than the losses it prevents. A cluster of revenge trades following a specific type of loss might reveal exactly which emotional trigger is most dangerous for that individual. These patterns, once seen clearly in the written record, cannot be dismissed or rationalized away. They are right there in the trader's own handwriting, session after session, confirming the same behavioral reality. And awareness of a pattern is the essential prerequisite for changing it. Without the diary, the same patterns will repeat indefinitely because they never become visible enough to be consciously addressed. Elder also recommends annotated chart files alongside the diary, a collection of charts marked up with the trader's analysis at the time of each trade. Comparing what was seen before the trade with what actually happened afterward teaches the trader, over time, which analytical methods are reliable and which are prone to generating false signals. A technical setup that appears compelling on the chart but consistently fails to produce the expected result in practice is telling the trader something important about the reliability of that particular pattern in that particular market. The practice of grading trades by process rather than by outcome is one of the most sophisticated and most important habits Elder recommends. A trade is graded excellent if it was entered for the right reasons, managed strictly according to the plan, and exited in accordance with the rules, regardless of whether it was profitable. A trade is graded poorly if it deviated from the plan in any significant way, regardless of whether it happened to make money. This distinction is not philosophical. It is the practical foundation of long-term performance. Correct processes, applied consistently over a large enough sample of trades, produce profits. Incorrect processes, however lucky they are occasionally, produce losses over time. Beginning traders evaluate every trade by its financial outcome. Professional traders evaluate every trade by the quality of the decision-making and execution behind it. This shift in evaluation framework is one of the most visible markers of the transition from amateur to professional, and the trading diary is the most effective instrument for making and sustaining that shift. Chapter 13: The Professional Trader: Mind, Method, and Money in Practice. We have traveled through every major dimension of trading that this book addresses, from the psychology of the individual trader to the behavior of the crowd, from the tools of chart analysis to the precise mechanics of the triple-screen trading system, from the principles of capital preservation to the habits of continuous self-improvement. Now we arrive at the synthesis, the portrait of what it actually looks like when all of these elements are working together in the mind and practice of a professional trader. The professional trader is not what popular imagination suggests. The caricature that popular culture loves is of someone thriving on adrenaline, making dramatic split-second decisions, living on the edge of financial exhilaration. This image is almost entirely fictional. The most successful traders Elder has known and studied over his career are, in most important respects, the opposite of this image. They are calm. They are methodical. They are patient to a degree that would seem almost boring to an outsider. They are not drawn to the market by the excitement of the action. What they care about is process, consistency, and the steady accumulation of edge applied over thousands of carefully executed decisions. The professional trader has a precisely defined edge, a set of conditions in which they have demonstrated through testing and experience that they have an advantage over other participants. This edge may be grounded in a particular technical pattern in a particular market, a specific combination of indicators that has proven reliable over years, a specialized understanding of the dynamics driving a particular sector, or a disciplined application of a timing methodology like the triple screen. Whatever it is, the professional knows it clearly and specifically. They know when the edge is present and when it is not. The professional also knows what their edge is not. They know the market conditions that produce false signals from their approach, the environments where their system generates losses rather than profits. When those environments arise, and they periodically do, the professional does not try to force their system to work in conditions it was not designed for. They step away. They preserve their capital. They wait, without frustration and without restlessness, until the conditions return that favor their particular approach. This willingness to do nothing, to protect capital during periods of market behavior that does not suit their methodology, is one of the most important and most underappreciated characteristics of the professional. The professional trader has also built a genuinely healthy relationship with losing. Not a comfortable one. No one enjoys taking losses, but a realistic and mature one, grounded in the understanding that losses are an inevitable and expected component of any trading system that is run over a sufficient number of trades. No system wins every trade. None ever will. The professional does not take individual losses personally. They do not allow them to shake confidence in a well-tested methodology. They have a clear statistical expectation for their system's win rate and reward to risk profile, and they evaluate their performance against those expectations over sequences of trades, not individual ones. A loss on a correctly executed trade is not a failure. It is simply one data point in a larger statistical story that is telling a profitable tale overall. The professional trader is also committed to continuous learning and adaptation. Markets are not static. The patterns that produced reliable signals in one era may gradually become less reliable as more participants discover and exploit them. The professional stays current with new developments in market research and methodology. They continue to test and refine their approach. They remain willing to update their methods when the evidence suggests something is changing. They are loyal, not to any particular indicator or system as a matter of habit or pride, but to whatever the evidence says is currently working. Intellectual honesty about performance is one of the professional's most valuable characteristics. Elder closes the book with a reflection on what trading truly offers and what it truly requires. It offers, for those who develop the necessary skills, a form of financial independence that is almost without parallel in the modern world. The ability to generate income from anywhere in the world, without bosses or fixed hours or artificial ceilings on earning, is a genuinely extraordinary possibility. But it comes at a price that most people are ultimately unwilling to pay: total and absolute personal responsibility for every result. There is no one else to blame when trades lose. The market is not malevolent. The broker did not cause the loss. The economic news that moved against the position was not a conspiracy. The trader and the trader alone is responsible for every entry decision, for every stop loss that was or was not honored, for every position that was sized too large in a moment of confidence or too small in a moment of fear. This radical personal accountability is both the greatest challenge and the greatest gift that the trading life offers. It is a mirror, a precise, unforgiving, and ultimately transformative mirror that reflects back, with perfect fidelity, exactly who you are when real consequences are on the line. How disciplined you truly are. How honest you are with yourself in the moment of being wrong. How patient you are when the market tests your conviction. How rational you can be when the emotional pressure is at its highest. The traders who can look honestly into this mirror face what they see without flinching and commit to the daily work of becoming better, those are the ones who find their way to the goal that the title of this book describes. Trading for a living is not a fantasy reserved for a lucky few. It is a skill that can be learned by anyone willing to approach it with the seriousness, the humility, and the patience it deserves. The three pillars are mind, method, and money. Master the mind, and you will trade without fear or greed, clouding every decision. Master the method, and you will have a reliable framework for identifying and acting on genuine opportunities. Master the money, and you will protect your capital through every storm the market sends, surviving to trade another day and the day after that, and for as long as you choose to engage with the world's most demanding and most rewarding discipline. That is the complete message of Alexander Elder's extraordinary book. Not merely a guide to technical indicators or chart patterns, though it is both of those things in considerable depth. Not merely a lecture on discipline and psychology, though it speaks to both with unusual insight and authority. It is a complete philosophy of trading, built carefully and deliberately from the inside out, beginning with the deepest understanding of the human mind under pressure and building outward through every practical skill needed to translate that understanding into consistent, disciplined, and profitable participation in the financial markets of the world. The journey does not end with the last chapter of this book. It ends, or rather it truly begins, the moment you sit down at your desk, open a chart, and begin to apply what you have learned here with the honesty and discipline it deserves. That moment is where the real work begins. And if you approach it the way this book teaches, with patience and self-awareness, and a system you have genuinely tested and trusted, it is a moment that can change everything.